Hello guys, welcome to this video lesson, and today we are going to talk about trade journal. Now, if you have probably not watched any of my video before, I do not like to edit my video. I like to film everything raw from start to finish. So if I make like an error while talking, just understand that's me trying to be as authentic as possible. Yeah, now the goal of this video is to talk about trade journaling. And how that is absolutely necessary to your long-term consistency as a trader. Now, I am also going to tackle this from a different lens, and the lens essentially is a value system. I do believe that for you to be effective at improving yourself as a trader, what is a must is for you to journal your trades. And we're going to talk about why it is absolutely necessary for you to journal your trades and how to go about journaling your trades. But before we talk about all of these, we need to talk about trade journaling from a psychological or mental standpoint. Now, if you study a lot of traders, a lot of retail traders, when it comes to what we do in this industry, a problem that I've noticed from a lot of people is the emphasis on win rates. There is so much emphasis on win rates. Okay, just a lot of emphasis on win rates and sniper entries. And, if you post, trades with like insane win rates or like crazy sniper entries, it gets a lot of likes. Like, just go on Twitter, for example. Go on Twitter and you would see the main thing people talk about. And that's why you rarely see people talk about losses, or you rarely see people post your losses, because losses are not, you're not sexy to post. Losses are not, it's not a good, people don't want to talk about losses. People don't want to relate to losses. Everyone wants to see that you had a winning streak. I'll give you an instance. So again, I want to be really honest. I really don't care, but I had a time where I was making around like $2,000 on my Discord. So I do run a Discord service, and I was making around like $2,000 per month, an average for my Discord service. Sometime last year, towards the end of last year, and I had a period where I went on a run for like 3 months, and in the span of that 3 months, from the live streams and trades, we took only 3 losses, and I was documenting everything on Twitter, or you could call it X. And I am not going to lie, the monthly revenue went from $2,000 a month. By the end of that 3 month period run, where we're going on insane winning streaks and runs, it went from $2,000 a month to 12K a month. So it literally went 6 times the amount, because a lot of people, they found that insanely impressive. And I kept reiterating that this is due to market conditions being good. Market conditions were easy to trade, because that was literally my model. So I know where my model would thrive and where my model would not thrive. So I knew that was a period in time where I would make a lot of money, and that was just a natural performance for me. But the revenue reflected the psychology of retail traders. Insane win rates are like sexy to people. They're impressive to people. Sniper entries are impressive to people, right? But being able to trade out of drawdown, it's not impressive. And this is why I tell people the true test of a trader skill set is your ability to keep risk consistent while you're in drawdown. Your value system has to shift from focusing on profits, because that's what everyone else is thinking about. That's what everyone else is focusing on. This is everyone else's value system. And that's why most people would never make it in trading. Because when your value system is so focused on profits, when the emphasis of what you do as a trader is so focused on profits, what happens is, when you get into a situation where maybe market conditions are not suitable for your model, or when you get into a condition or a situation in which you are in a little bit of a drawdown, it is easy for you to mess things up, because now you don't know how to make a switch from, being disciplined to wanting to make profits. And this is what a lot of people would do, where when they're making profits, it's easy for them to trade well. It's easy for them to go into the marketplace. They're excited about waking up the next morning to look for trades. And I'm sure that if you're probably watching this video right now, you can probably relate to this. They're excited about watching, trades and stuff. And then as soon as they go into a little bit of a drawdown, they inadvertently always end up going on a tilt. Why? Why do they go untold? Because they do not know how to manage themselves emotionally when they go into a period of drawdown. Because now they're not making any money. And because you're not making any money, they feel like you're not making progress towards your goals. And they don't understand that every trader goes through periods of drawdown. This is a natural part of trading. You're going to get good market conditions, you're going to get shit market conditions. What determines the outcome is your ability to weather the shit market conditions through discipline. The only way you can be disciplined to not fuck up your trade, to not fuck up your equity, is if your value system is placed differently from everyone else, which is what, again, the point of this video is to talk about how to journal. But I feel like if I don't talk about value system as a trader, then essentially I am not doing a good job of teaching how to journal and why journal is absolutely essential to your profitability as a trader. The only way I believe that journaling would be essential to your, or not essential, but the only way I believe that journaling trades would actually work for you is if your value system shifts from focusing on profits to focusing on routines. What you need to understand about trading: consistently profitable trading is not a matter of just your model. Consistently profitable trading is a routine. It is a refined routine. It is waking up every week, doing the same shit, and getting 1% better at doing the same thing every day. This is why I talk about when I get on the charts. It is the equivalent emotionally. Going on the charts is the equivalent of checking my emails, because I already know what I'm doing, because I have been doing this for years. So I know what I'm doing. The only thing I do is here and there, I'll get feedback from the marketplace to refine my approach to the marketplace, to refine my routine. Your goal has to be to find a routine that can be worked on and refined and improved upon. Because if you can find a routine that can be, when I talk about a routine, I talk about a mental routine and then also a physical routine when it comes to your trading checklists, your entry model, your confirmation checklist, your low probability filter. Like, these are things that has to be a part of your model. Now, the goal of this lesson is not about your model. I don't give a fuck if you trade trend lines or you trade indicators or you trade Bollinger Bands crossovers with like stochastic RSI or whatever. That's none of my business. The goal of this lesson is not to teach you how to define your model. That's your job. Okay, your job is to define your model. My job is to teach you how to make that model actually work for you. And it all starts with your mental approach to trading. The first thing you need to understand about trading is the biggest test of a man is money. And that's why if you look at a lot of religion, they talk about money as the biggest temptation of a man. And you are dealing in an industry that directly involves that entity, which is money. So it is so easy to lose yourself in the process. It is so easy to lose discipline in the process. The only way you can gain back control. So what I want from you, before we go into protocols, I'm going to talk about how to approach journaling your trades and how to use that to refine and improve upon your trades. The only way that this can really work for you is if you make a decision today. Okay, you have to make a decision today that every single action you take on the charts has to be because you intended it to be. Let me explain why. If every decision you're making on the charts are intentional, they are purely intentional, and they're conscious decisions you're making because you've made calculated risks, your performance would be light years ahead of everyone else. Because the problem, if you look at a lot of traders, they are mostly break-even traders. They're up and down. It's never consistent. And the reason why it is never consistent is because a lot of people are not self-aware and their value system is all messed up. So what they do is they could follow your model and take profits here and there. But in between those profits, they could get overexcited about the fact that they made profits the day before, and then that causes them to impulsively trade today against your model. Again, I'm going to talk about, how to deal with temptation from last week's trading, because I also went through the same thing. And a lot of people think the more years or experience you gain when it comes to trading, you're going to magically just get rid of all the emotions when it comes to trading. And that's not true. The only thing that happens is you get more self-aware, and then you don't impulsively act on your emotions. I still deal with the temptations of wanting to execute against or outside my rules. I still deal with all of these temptations. The good thing is I am self-aware, so I know what to do because I have a routine that actually fixes that problem. Your value system has to be, the emphasis has to be placed on routine. If you take a trade following your routine, regardless if the trade is a winning trade or a losing trade, that is good. You have done something good. If you take a trade against your routine, regardless if you made $1,000,000, that's a terrible trade, because what you're doing is you're reinforcing bad habits. You're teaching yourself to trade poorly. I have a friend who he has periods in time where he'll make a lot of money when it comes to trading, right? So he'll trade and he'll make insane amounts. When I'm talking about insane amounts, I'm talking about half of six figures within the span of a week. And he's doing this with 5K or 4K. And he would run up crazy numbers like that and then send them to me and show oh, well, where to go. I'm so good at trading. This is something that's been going on for a while now, for years. He'll go quiet for extended periods of time, and then he'll have a moment where he makes a lot of money. He flips his account crazy. Maybe he does 4K to 27K or 4K to 70 something K. And he'll send that to me and be oh, well, see, this is why we're the best in the business, None of that is impressive to me. I'm not going to lie. It is not impressive to me, because what about all those weeks where you're blowing accounts? What about all those weeks where you're losing tons of money? No one knows about the weeks where you're losing money. And that's why no one wants to talk about losses online. No one wants to talk about the fact that they're taking losses. Everyone only wants to talk about the winning trades. Because taking profitable trades shows that you're smart to people. It's kind of like an ego thing to people. And this is why you have to learn to detach from the... Okay, let me put it to you guys this way. Do you think the average trader makes money consistently in the long run trading? We all know the answer. The answer is absolutely no. The only way you can beat the game is to do things differently to everyone else. It is to approach the markets differently to everyone else, psychologically, emotionally. You have to approach this differently to everyone else, because everyone is so focused on the profits, wins and losses, Your focus has to be in routine. So once you have your model, at the end of every single day, you have to ask yourself the question, did I follow my model? Yes or no, irregardless of trade outcome. If you followed your model, you've done something positive for that day. You're making progress. You cannot measure progress by the amount of money you're making. You have to measure progress by your ability to trade the model. Now, let me explain why this is absolutely necessary. The reason why this is absolutely necessary is because when you trade your model strictly, the good thing about your model is it can be refined. As you gain more information, as you gain more experience, you can refine it. You can make it better. It's like an algorithm. It's like machine learning, right? As you get more information, you get better at making better decisions. That's how it goes. If you wanted to use ChatGPT, for example, if you gave ChatGPT arbitrary commands, arbitrary instructions, do you think the response you're going to get from ChatGPT would be to your taste or to what you like? It's not going to be to the level of detail that you like or you want for yourself. But if you gave ChatGPT specific instructions, detailed instructions, your response would be more to the kind of taste you like. Now, again, this might be like a really weird example, but I just want to liken it to what it is when you strictly trade your model. Because the good thing about your model is devoid of emotion. It is logic based. All you're doing with your model is, where do I thrive? Where do I not thrive? That's the main question you're asking yourself. If you know you thrive in trending market conditions, then you know historically, like for example myself, which is something I talked about last year, I know historically between the months of like September to November, there are certain characteristics I look for in the marketplace, and within the span of those 3 months, I usually end up making way more money than I made the whole year. Like the whole months prior to September to November, I make way more money than those. So when market conditions are shit, usually going towards August, I'm usually calm because I know, okay, September, November is coming, and I know that's when I go absolutely insane. That's where we had the winning streak last year, where I was telling everyone, once September comes, that's it. We're gonna start to go just absolutely insane, and yeah, that's because I know over the last 4 to 5 years, it's always been this way. It's always been the case because market conditions are smoother due to like historical price actions and stuff. Because I know my model, I know where my model thrives, I know where it does not thrive, and I know how to approach the markets. I know how to reduce leverage. I know how to be extremely strict with risk when the markets are not suitable to my model, like in this kind of market conditions, for example, where it is just a lot of back and forth. So if your model is a kind of model that thrives in a consolidation profile, then you know that once you identify consolidation profiles, you know what you're looking for. But if you cannot follow your model, if you cannot be strict with your decision making to align with your model, what you would have done is now you've gone from being a speculator to being a gambler. And in every individual, there's always two entities battling for control. There's a part of the speculator, which is disciplined. That individual is someone that is disciplined, strict with risk, strict with the approach to price action, because he or she understands the emotional toil the markets can cause in them. Versus the gambler. The gambler does not care about rules. The gambler does not care about protocols. The gambler does not care about clawing his or her way out of drawdown. The gambler only cares about the dopamine rush that comes from trading, the dopamine rush that comes from seeing blue and on the M24 and M25. That is most traders. That is most people. If you're listening to me right now, you might think you're not that person, but there are times where that side of you comes out and fucks you up. And that's why you still end up blowing accounts. I made a video recently and I talked about how extremely difficult it is to blow a funded account. So the question is, why are you still blowing accounts? Because you don't have the emotional discipline to trade out of drawdown. Because trading out of drawdown is not sexy. And this is where I talk about value system. This is the easiest. Again, I'm so sorry that I am going on a really long rant. When I make videos like this, I'm really passionate about wanting to get people to see things from my perspective. But one thing you can do that would right now fix this side of this part of you that struggles. Again, I talked about this in the previous video, but I'm just going to rehash this again on this video. What you need to do is you need to define who you want to be as a trader. What would the dream life be for you? What's the goal? Do you want to trade for like a firm? Do you want to have your own equity in terms of like 8 figures and 9 figures, 10? Like, think about what the ideal version of yourself as a trader would be like. Write that down, okay? Now, every single day, your job is to act and behave like that dream version of yourself. And I can almost guarantee, if I asked all of you guys, if I could see all of you guys in person, I asked all of you guys, what would the dream version of yourself as a trader look like? You would most likely tell me that the dream version of yourself is someone who is extremely disciplined and really, really wealthy. You need to understand, for you to create wealth from trading, it has to come as a result of your routine. You have to look at your routine as like investments in your future, because with your routine, you can refine them. So a really nice example would be, there was a time, like I think that was 2021. There was a time 2021 where I took out a loan from a bank. So I took out a loan from a bank for a real estate project. I think I posted this on Twitter and also on my Instagram. I'm not sure. A lot of you guys who've been following me for a while, you probably know about this. There was a time where I took a massive gamble and went to the bank, took out a loan to pay for a real estate project, and my only means of paying back the interest. So the interest was usually on the 17th to 19th of every month. So every month I had to pay back a part of the loan with like interest, right, to the bank. And if I failed a payment, then essentially what would happen is I would lose my real estate. Again, the stakes were really, really high back then. I'll lose my real estate. I'll lose my collateral. Okay. And I could not afford. And all the payments I made the months before, essentially all null and void. So I am losing like 4 to 5 times what I took out from the bank. Okay. And the only way I could pay back the loan was to trade. I could only trade and use the profits from trading to pay back the loan. And me, my dumbass thought, okay, what I could do is I needed to trade more to make more money to pay back the loan. Now, let me tell you what happened. I was trading agent session. I was trading London session. I was trading New York session. And I was trading London close. Now, prior to then, I only used to trade New York session and sometimes London session. But it was mostly New York session. But now I was taking the same amount of trades during Asian session. Can you see how insane that is? I was taking the same amount of trades during Asian session on pairs like Aussie dollar, US dollar, cable, GBP US dollar, USD CHF. Like I was trading these pairs during Asian session. What happened was one of my, if not my worst trading period in years. My win ratio was like, I think it was like 7% or so. Like out of every 10 trades, I was winning like 0.7 out of 10 trades, which is absolutely insane. So it ranged from like, because most weeks I would go with like, I'll take, like my usual trade frequency is like 6. Back then, it was like 5 to 6 trades per week. That was like my usual trade frequency. I was doing 15 to 20 trades per week. Because I was trading Asian session, I was trading London session, I was trading New York session, I was trading London close. And then what actually happened was I was losing money faster than I could keep up. Because I had to keep taking money from my equity to pay back the loan. So now, not only am I not supposed to make profits, I was not making profits. I was losing money. And not just losing money like slowly, I was losing money really, really, really fast. So I was losing money so fast. And I was using part of the money to feed myself because expenses. And I was taking money out of that equity to pay back the banks because I did not want to lose my collateral or essentially losing all your history of like paying back the loan and also losing your real estate. Like it was a lot of pressure. So it was a span of like between February to May, around that time frame. I was losing a lot of money. It was insane. And then sometime around like September going to November, when I was reflecting on that time period, I realized that 95% of the trades I was taking, I would not have taken them. The me a few months after would not have taken those trades. So I was asking myself the question of like, so why the fuck was I taking those trades? Like, it does not make any sense whatsoever. Why the fuck was I taking these trades? And then it clicked. I wasn't thinking straight. I was reacting emotionally. When you're reacting emotionally, it's like when you're angry. You know, there's some people where if they're angry, they say things they don't really mean. But the emotions are just like overwhelming. That's the same thing with trading. When you trade like that, now the outcome is now outside your control. The goal is the outcome always has to be in your control. Every fucking time you take an action on the charts, it has to be because you intended it to be that way, because you're following logic. The only way you can win in this game is to be logical in your approach to what you do. And the only way you can be logical in your approach to what you do is to follow your model. And the only way your model can work for you long term is to be able to refine your model. So now this is where we go into the part of like talking about journaling and how to journal. So what I have here on my screen is protocols for journaling. This is how essentially after every single trade, this is how I log in all my trades. So what we have here is the date or day of the week. Now this is necessary because I want to know what days I trade better. So I do have a protocol which I've done models. One of my models which I shared to my my Discord community is the only time I'll go and trade on Monday is if the previous week's Thursday or Friday. Okay, so if last week Thursday or Friday we created a long term, if last week Thursday or Friday we created a swing in direction of daily order flow, but we have not seen significant expansion yet. Okay, so if we created a swing the last week Thursday or Friday in direction of item from order flow, and price has not expanded significantly yet, then I know that Monday would be used to continue that price delivery. So that is the only time usually I go in and trade on Monday. Why don't I trade on Monday? Because from journaling, logging my trades, I realized that the most times I take losses is on Monday and Friday. The 2 days out of the week, out of the 5 days, out of the 5 trading days, that I take the most amount of losses is Mondays to Fridays. Mondays and Fridays, not Mondays to Fridays. Now, that does not mean I don't trade Mondays. It just means I have a stricter protocol for trading Mondays because I know historically I'm more likely to take a loss on Monday. Can you see how feedback? Again, I'm using all of this topics, like each of this individual, is it topics we're going to call it? Or what's the word? Points. Yeah. So I'm using each of these individual points to refine my model. That's how I got here. That's how I was able to refine my model. The reason why you log in the days of the week is because you need to know what days your model performs better, and under what conditions within those days your model performs better. And that's why I created the protocol of, if Thursday or Friday, the person before creates a swing in the direction of item from order flow, and we have failed to see an expansion, then I know that Monday is more likely to continue. Now, that does not mean I just go and trade on Monday and just look for any setup, or I still go through my checklist and everything, but it just means that Monday is now a potential trading day. That's what it is. If this part of my model, if that part of the model is not presented, I don't trade on Mondays typically. I just ignore Mondays and I don't trade. And the reason why I was able to arrive at this model is through journaling, by logging my trades. As you do it consistently, the goal of going through checklists like this is to identify patterns. That's what you're looking for, and that's why trade journaling is absolutely necessary. You are trying to identify patterns that can be refined, eliminated, or improved upon. That's the goal. Again, the reason why I had to talk about value systems is because if your value system if the emphasis is not placed on being decisive, making the best decisions on the chart, essentially none of this would mean absolutely nothing to you. Because even if you log in and journal all, and you realize that, okay, Monday, I really don't perform good on Monday. When the next Monday comes and you go on your M24, M25 on your phone and you see something that looks good, you're still going to impulsively act on that decision or emotion. And a lot of you guys, most times, you don't realize that you're impulsively acting on emotions. Most times you get on the charts, you see something that looks good, and you take it. You take the trade just because it looks good. And I've taught my students, you can never take a trade because it looks good. Why the fuck would you, if I gave you $100 million, and I'm using this extreme example because that's the only way it'll make sense to your primitive brain. If I give you $100 million and said, okay, trade this amount, grow this equity, would you go and take a trade just because the trade looked good? Absolutely the fuck not, because you would be panicking once you place that trade, because you're taking a trade to fill an emotional void. You're not taking a trade because you plan for it. Your goal has to be a professional money manager. The only people who create careers out of trading are individuals who are professional money manager. I don't care about the fact that you know Enigma. I don't care about the fact that you've studied an insane model. I don't give a fuck. If you cannot be professional in the way you risk your equity, you cannot do this long term. You're not going to make a career out of this. You're going to blow accounts. You're going to fail. over and over, and you get frustrated at yourself. So the first thing you need to do in your checklist is you need to log in the day of the week. So the date and the day of the week, right? So the dates, meaning you've identified the month, okay? And that's why I know typically around the month of August, typically around the month of like June to August, they are poor months for me, historically, right? Poor months in terms of like, I'm not taking as much trades. Accuracy is not as good as I would like it to be. Win rate is not as good as I would like it to be. So I know during months like this, I have to be stricter in terms of my approach. I cannot just take any trades, right? I have to be more selective about trades. So what you do is as you log in. Oh, by the way, I live really close. So my apartment's on the corner of the street. I don't know. I just selected this because I wanted to see all like the cool cars go by. So sometimes you're just going to hear like really loud car exhaust noises. So I do apologize about this. This video is turning out to be really, really long. Let's see. Yeah, we're like half an hour in and have not gone through the rest. Yeah, we're going to go through the main points. Anyways, so you want to log in the date. So for example, if I wanted to log in a trade from like today, the first thing I'll do is June 16th, right, 2025. And then the day would be Monday, right? So it could be Monday, June 16, 2025, or June 16, 2025, Monday. But it is essential to have the day, the month, and then the year, right? So, of course. And then the next step is the pair, right? What I are you trading? Then number 3 is the entry time frame. What time frame are you trading? Now, I used to trade the 1 minute time frame before. So I did have a model called my high frequency model. And it was around the month of September. Oh, sorry, around the month of November. So November 2021. Okay. November 2021. I had around 21K in my equity balance. And I grew that 21K to not 401. I think it was around 201K or so. That was my best one ever. And all I was doing, I was just essentially trading high frequency. I call it high frequency. It's not really high frequency. I was just essentially trading a 1 minute chart. That's all I was doing. And I was going balls deep in risk. Like I didn't give a fuck. That was like a few months after the bank thing, after I had like the bank situation. And it was my best one ever in terms of like equity growth because I was just trading. It was a lot of trade frequency and the money was insane. And after that month, I felt like, okay, I had found the new hack to trading. Okay. I was like, I thought, I'm not going to lie. I felt like I was on top of the world. So I felt like, I could go in and trade like that. And 2022 really humbled me because I tried that similar approach and it failed miserably. Many times it failed. Okay. And so what I realized was the reason why that model succeeded, because I had to revisit, because I was starting to realize, okay, why is that I'm taking a loss? Because, when you took a trade and it ends up being the losing trade because you're following your model, you have to log in all of these things: the date, the pair, entry time from order type, entry PDA, And then as you log in all of this, you start to realize a pattern, right? Why is that when I log in a trade and the entry time frame is like M15, M30, it's a winning trade. But then I log in a trade and the entry time frame is M1 or 15 second, it is a losing trade. So now I notice a pattern where most times the M15 to M30 trades were profitable, but the M1 trades were almost always a losing trade. So now that's feedback. There's something wrong with the approach, that M1 approach. So I had to understand what was going on. Why is it that when I take a trade off the M15, M30 time frame, it is like 90% of the time it's going to be a winning trade. But when I take an M1 trade, almost 100% of the time it's going to be a losing trade. Even though the market is simply in my direction, but it's still a losing trade. And then I realized the market condition in which I was trading in around that month of November was unique for me. It was unique for my model. So what did I do? I had to adapt and then adjust. So now I went from trading the M1 time frame to now trading M15 time frame and M30 time frame. Because I knew that if I continued to trade that time frame, just from statistics, I was more likely to make money. And it worked. It worked. Okay? So what we do is we log in the date. The reason why we have each of this do you want to call this topic? I don't know what you want to call this, but the reason why we have each of these points in our protocol for the login of our trade is to find repeating patterns. So are you trading at the wrong day of the week? Is it that whenever you trade a cross pair, maybe GBP, JPY, GBP, Aussie, you're taking a loss? Which again, that's also why I don't trade cross pairs often. Because if I want to trade a cross pair, if I wanted to trade an asset like GBP Aussie, for example, not only am I going to have to do an analysis on GBP Aussie, I have to do an analysis on GBP US dollar. I have to do an analysis on the AD US dollar. I have to know the direction of the XY before I can then make an informed decision on GBP Aussie. So it's a lot of work. And again, the reason why I was able to come to this conclusion is because I noticed that my win rate was higher. Like the statistical probability of a profitable trade was higher when I traded a major currency versus trading a cross pair. Because most times when I was trading cross pairs, it was a lot of break-even trades. I'll move stops way too early. And then the market will still move in my direction, but again, I'm stopped at break-even. So the option was to either hold trades for a few days, which I did try, and I was taking some losing trades here and there, and I realized, okay, no. Again, all of the things you see me do now, which feels like they're so insane, is due to years of refining, years of understanding what works and what doesn't. And the only way you can get to that point is by understanding your routine, your patterns. And then you can fix your routine, you can fix your patterns. Okay, so the next one is the order type. Right, so entry time, we've talked about entry time frame. Now let me just talk a little bit more about entry time frame before I go and talk about order time. Now for entry time frame, the entry time frame determines your trade profile. So entry time frame and trade profile, they're kind of interrelated. Okay, entry time frame and trade profile. If you're taking a trade on the 1 minute chart, most likely you're not swing trading. Okay, most likely you're not swing trading. Most likely you are scalping. Your intra-session scalping and the 1 minute time frame. If you're taking a trade on the daily time frame, I don't think you're scalping. Just no fucking way you can scalp on the daily time frame using daily candles. It's most likely a position trade, right? So they're all interrelated, and so you need to define what kind of profile works for you as a trader. Are you the kind of person that is quick to make decisions? Like you're fine. And again, your trade profile determines your risk. So let me give you an example. If I am a scalper, so I've talked about how as a trader, you need to define your daily risk limit. So let's say you're trading a live account, for example, a live funded account, your daily risk limit would probably be something like 1% risk per day. So meaning if you take a trade, if the cumulative loss for that day reaches 1%, you stop trading for that day, right? So this is what we'll call your risk limit, your daily risk limit. Now, if you're scalping, you cannot scalp with a 1% risk per trade, because as a scalper, you're quicker to make decisions. You're quicker to close the trade because you're expecting quick feedback from the marketplace. So if you go and take a trade as a scalper, if you take one trade and you're stopped out, now you're done for the day. And you know, as a scalper, sometimes it could take you 2 or 3 tries to know something. Because, again, the frequency of trade for scalps is way higher than the frequency of trade for short-term trades, for example, or swing trading, for example. The number of opportunities as a scalper is way more than the number of opportunities than a short-term trader. The number of opportunities for a short-term trader is way more than the number of opportunities for a swing trader, and then on and on for like position trade. So if we assume, for example, that your daily risk limit is 1% per day, why are you scalping with a 0.5% risk? That means you're only giving yourself two chances. And if you take two losses, you're done for that day. Because your trade profile is you're a scalper. So a better approach would be risking 0.25% instead per trade. So that means now you have four chances or four opportunities to scalp. So if you take four back-to-back losses, you're done, because four back-to-back losses at 0.25% per trade equals 1% daily risk limit. So can you see how your risk adjusts depending on your trade profile? You can see trading itself is a skill. It's not like just analysis. There is a skill set to trading, to actually trading. It's all calculated. These are things you should be doing as a trader, which a lot of you guys actually ignore. If you're a trader without a daily risk limit in the first place, you are not a professional trader. You're not even trading, you're gambling. You're gambling, bro. Because you cannot define when you need to stop trading. If you cannot define when you need to stop trading, it becomes easy to blow an account because you're trading without rules. So again, entry time frame, you have to log in the entry time frame. If you're trading M15 time frame, most likely you're day trading. Okay, I was supposed to include that here. So we have position trade. When we talk about trade profiles, there's 5 trade profiles. We have position trade, where you're holding trades for like months, right? So most times you're executing, your time frame of execution is on the daily time frame. Again, all of this is all discussed on my course. I'm not trying to sell myself on YouTube. I'm just saying, I don't want to have to go in detail and make this like an hour plus video. But we have position trade, we have swing trade, we have short-term trade, we have day trade, and then we have scalp. It all depends on your risk appetite, your daily routine, right? Your lifestyle choices that determines your trade profile. But when it comes to entry time frame, if you're using like M15 time frame, we're talking about day trading. H1 time frame is more short-term trading. M30, H1 time frame is more short-term trading, and on and on and on. Okay. So after you define your entry time frame, then we go to order type. Now, most times I am doing market execution. So if you find out that, also you're not only logging your profitable trades or losing trades, you're also logging your break-even trades and also your missed trades. So if you miss a trade, are you missing that trade because you're setting limit order? Do you think you would perform better if you went from a limit order to a market execution? Do you think that could work? If you're going to do a market execution, is there a way for you to set an alarm so if price reaches your areas of interest, you can go and market execute? Like, these are questions you're asking yourself. The only way you can find out what works is if you journal all your trades. Missed trades, profitable trades, losing trades, break-even trades, right? Those are the 4 trade outcomes, right? If you miss a trade, if it's a profitable trade, meaning trade got to target or you closed the trade in profit. If it's a break-even trade or if it's a losing trade, right? So your order type, it could be a limit order, a buy limit order, sell limit order, a stop order. You're buying a breakout, you're selling a breakout, or a market execution, you're buying or selling a market. Like, you need to define all of these things. Now, number 5 is your entry PDA, right? So this is where it is slightly more tuned or refined. Again, this is how I personally journal my own trades. So you could change the topic for yourself. So entry PDA simply means the entry was off of what? Okay, so maybe if you trade trend lines, for example, you could say, well, I bought the third test to a bullish trend line, the retest of a bullish trend line or plus support or something, or I bought a confluence of the 32.6 Fibonacci level along with the third test of a bullish trend line. Like, I'm just using an example. If you don't trade institutional like I trade, and a lot of people are probably watching the video trade, right? But again, this is how you can refine this for yourself. But when it comes to entry PDA, essentially what I mean is, what PDA array am I trading off of? Again, this is why I like propulsion blocks. When I take a trade off of a propulsion block, it gets me excited because I know almost all the time it goes in my direction, because the feedback I expect from a propulsion block is like immediate, right? Propulsion block entries or balance price range entries, I love the feedback from them because the feedback is usually very responsive. And I knew all of this from, again, journaling my trades. So that's why it is absolutely important to log in your trades. I don't know what keeps making the noise. And I think this video is starting to get way too long. Yeah, we're almost going to an hour because I like to yap, which is not good. Okay, next up is the trade profile, right? So trade profile, again, I already talked about this with the entry time frame. So the entry time frame determines your trade profile and also your expectations, right? So are you expected, the trade profile essentially is the time frame of your expectation. So if you're expecting the market to get to your target within a session, then more likely you are scalping, all right, or you're day trading. If you expect the market to get to your target within the span of a day or two, possibly 2 days, you're short-term trading, right? So your expectation determines your trade profile, which also determines your entry time frame. And then number 7 is your entry model, right? Your entry model could be whatever, right? So it could be, are you taking an entry of an AMD model, for example, or are you taking an entry of a Tesla model? Like, you have to define your model. Again, my goal is not to teach your model to trade. That's your job. Like, this is none of my business. The point of this video is telling you what you're supposed to do after you take the trade. But that's the point of the video, right? So number 8 is the entry session in time, right? So what session are you taking trades? When I was logging my trades, if you go back to the story of when I was owing the bank's money and I was taking trades during Asian session and then London session. Now, I strictly only, not strictly, but 97% of my trades are usually between New York session or London close. 97% of my trade right now, New York session and London close, because I know that if I'm going to trade New York session, I have the backdrop of narrative from Asian session and London session to make a more informed decision. And that's why I like to trade New York session and London close. Right. Now, maybe last week I did trade more of London session, right? But the sessions in which I trade more often is New York session, London close. And again, all of this is all as a result of me refining when I trade, just knowing my routine and knowing how to refine my routine. I realized that I was more profitable trading during New York session and London close. So why would I still continue to trade during London session if I am way more profitable trading New York session? So that's why I just moved to strictly trading New York session, right? So Asian session, I really don't trade Asian session. I only trade Asian session rarely, and that's only on USDJPY. But this is really, really rare. Most times when I trade Asian session, there was a time where I took a loss. That was one of my worst week, and that was this year. And I traded Aussie dollar, that's AUD USD during Asian session. Let me see if I can find the exact trade. If I go on the 1 hour time frame, it's not too long ago actually. I'm not sure if I can find. I don't think so. It was like a couple months ago, where I went in and I traded Aussie during not New York session. I traded Aussie during Asian session, and I took a loss. And I was explaining to the guys on Discord that the trade was not, I was not following my model. That was an impulsive decision. I was so mad at myself. Yes, even after 10 years of doing this, I still sometimes, even though rarely, I still sometimes trade impulsively. Is it this trade? No, I don't think it's that trade. There was a time where I tried to go long on Aussie. That was after FOMC, and it was during Asian session. And I typically do not trade it during Asian session. So whenever you see me trade any pair that is not USDJPY during Asian session, that's because I am trading impulsively, right? So I already know, right? So again, this is all from like routine and knowing myself and knowing my routine. That's why I am so confident in myself, because what I do every day, it's something I've been doing for years. It's just nothing different. It's like you wake up in the morning and you go brush your teeth. That's what trading's supposed to look. That's what profitable trading actually looks like. And the good thing about this is like all of the fear and panic and excitement and everything, it kind of removes all of that because you're doing all of these subconsciously. You're not excited to trade because it's the same thing you've done last week. You're gonna do it this week, right? Like that's a good thing about this. Trading, the only way you can make trading work for you is if you can be able to get to a point where it is the equivalent of clocking into your 9 to 5. How many of you guys go to your 9 to 5? You want to show up to your work and you're so scared, or you're way too excited. No, you're not. You're not way too excited to turn up to your work. You're not scared to show up to your work. It's something you do to make money. That's what this shit has to be for you. That's what the fuck it has to be. That's where you have to get to. But the good thing about what we do is we can make millions from this. See, that's the cool thing. When you're on vacation, right? That's the cool thing. But aside that, when it's Monday or Sunday, like I have a routine. Sunday prep. On Sunday I'm prepping. Sunday and Monday I'm prepping for the week. Except if I expect to trade on Monday. If I'm not trading on Monday, then most times Monday is my prep work. That's what I'll prep for the week. Set expectations, set goals, This is what I'm looking for. And then Tuesday, boom, routine. Doing this, checking this checklist, checking that checklist. Like it's calculated, informed decisions every single day. Okay, so from the entry session, you need to log in your entry session and then the time of execution, right? So the time of your execution within the session. So if you're trading during New York session, for example, or you're trading around 8:30, if you're trading around 8:30, is it because there was news around 8:30, or there was news around 9 a.m., or were you trading around, like, you need to know the time within the session you're trading. Again, I'm going to try to rush the remaining few points because I already realized that we're starting to get into an hour, and I don't want this to get into an hour. So the next question is, what was the trade outcome? Was it a winning trade? Was it a losing trade? Was it a break-even trade? Or was it a mistrade? Just write it down. You don't need to write anything else. Just what was the trade outcome, right? Was it a winning trade or a losing trade? Break-even trade or a mistrade, right? And then number 10, save all the lessons and everything. I'm going to talk about what you're supposed to do after you've gone through all of each point, right? So number 10 is your stop placement. That's the most important question when it comes to stop placement. Why did you put your stop list there? Some of you guys try to be way too cute with your stop loss. You want to be too cute with your stop loss because you want to get a better risk to reward. If you're sacrificing your stop loss for a better risk to reward, you should not be taking that trade. Because stop loss is also part of risk management. So if you can understand why you put your stop loss there, you can start to identify patterns in which putting your stop loss a certain way works and when it does not work. Like what I've discovered is if I put my stop loss 2 PDI arrays above or below the PDI array I'm using to execute, then that is what works for me. So if I'm buying off a bullish order block at discount, for example, then I want to put my stop loss 2 PDI arrays below the bullish order block. So essentially I'm looking at a rejection block and then an old low. So that means my stop loss goes below the old low, right? And usually I do 2 to 3 pips below the old low. If I'm buying off a fair value gap, for example, a bullish fair value gap, for example, then the next question is, okay, I want my stop loss to be 2 PDI arrays below the bullish fair value gap. So what can I identify as a discount array below my discount bullish fair value gap? Well, is there an order block there? Okay, that's 1 PDI array. Is there a rejection block or an old low? Well, that's a second PDI array. So my stop loss has to go below those two, because if the market trades through my fair value gap, then I expect the order block to potentially reverse price. Okay, and if the order block fails, then I'm wrong. And in that case, I want to be wrong, and I want the market to take me out at this point. So that's the question with the stop loss placement is, why did I put my stop loss there? Is it because that's where I expect? Usually your stop loss has to be a level in which you expect the market to invalidate your bias. You're not supposed to place your stop loss because you want a better risk reward. What comes first is the stop loss before the take profit, not the other way around. What you guys do is you define your take profit first before your stop loss. Now, I know where the market is going to. The question is, if I put my stop loss like this, is the risk reward favorable? If it is favorable, I'm taking a trade. If it's not favorable, then it's a trade I can watch and not participate in. That's all. You don't need to take every trade with your analysis. Not every trade is worth trading. And that's what actually separates good traders from bad traders. Good traders most times are just sitting at a lot of their analysis. It is not every analysis you trade. Again, that's a different topic entirely. We're going to cover in a different video. So number 11 is, did I execute my plan, or did I execute impulsively? So this is a yes or no answer. Did I execute my plan? Yes. If so, that's it. No further analysis. Did I execute my plan? No. I executed impulsively. This is where you have to start questioning yourself. So in this part, if you executed impulsively, the next question is why? Why did I execute impulsively? Is it because I am on the losing streak? Is it because I panicked? Why? You need to understand what went wrong mentally or psychologically to make you trade outside your plan. Like, these are questions you're asking yourself. Number 12, did I violate any of my low probability filters? This has to be a part of your model. I don't care if you're trading Bollinger Band crossovers or EMA crossovers, whatever. Every model has to have a low probability. A low probability is when your model is least likely to make you money. You need to know what conditions deprives your model from making money. So if you took a trade that was profitable, but you violated your low probability filter, you have to define it. Because now what you've done is you've done something wrong. You've traded against your plan. Again, the goal isn't to make money when it comes to your trade journal. The goal isn't to log in a winning trade. The goal is to log in a trade that was taken following your protocol. Because with your protocol, you can actually refine them and get better. I have spent the last 1 hour giving you instances in which I was able to refine my model, and that's why I am at this point in my trading journey. Okay? Fuck. And then 13, I'm trying to rush all of this so we don't get to an hour. Am I satisfied with how I took profits? What could I have done better? Could I have held? Could I have taken partials? Some of you guys will be up a significant amount of money and you're not taking partials. Could I have closed at 2 hour? Could I have had for 3 hour or 4 hour? Again, my personal protocol is TP1 always has to be 3 hour for me. If TP1 is not 3 hour for me, I'm not taking a trade. I don't care if it looks good. Right? If I don't get a 3 hour trade, I'm not taking a trade. And again, because I know that if I can stick to a 3 hour trade for every take profit one, then it increases the odds of me losing money is so low. Because for every one trade I close at TP1, it is going to take me 3 trades just to break even. And that's all I like to do with that. And then once you're done with all of each topics, then the next phase is what I call a summary or a discussion. And the summary or discussion is just you talking about, again, this is, I did not include this on the protocol because 1 to 13, that's where you're logging. When you're done, the summary discussion is just you discussing things you did wrong or things you could have done better or patterns you're noticing, right? So after you've gone through each of the 13 points, you have to do like a conclusion to it for every single trade. Okay? I could have done this better. I could have done that better. I did this wrong. I did that wrong. Again, I'm not necessarily saying maybe you did not follow your model, right? You can follow your model, follow your plan, but again, there needs to be some. And also, you need to also understand that not every loss is something to learn from. A natural power of trading is that you take losses. Like I said, it's not every time you take a loss that means you have to refine something, because a lot of you people can get over obsessed with wanting to refine everything. I took a loss, so that means I did something wrong. Not every loss is something that you can refine. Some losses are just losses. They're just things you take. They're just the market did not play out. Again, you're not the one controlling the market. Okay, but if you took a loss not following your model, that's something that's wrong. If you notice a pattern, you're taking losses because there's a specific thing you're doing. Maybe you're trading this asset, but when you trade this other asset, you get a different outcome. Or maybe you're trading at this time of day, but if you trade at this other time of day, you get a different outcome. That's something you can actually refine, right? So the only time you're refining your model is when you notice patterns, or when you deviate from said model. Okay, I'm going to end the video here. You guys all enjoy yourselves, and I will talk to you in the next one. Trade safe.